Welcome to Iron Financial. This is the only place where we help you forge a stronger, more resilient portfolio by stress testing companies right down to their financial bedrock. Today, Sea Limited is on the anvil. You saw the headlines. The market punished the stock after its latest earnings report. But our job here is to cut through all that noise. We're going to find out if this company is a true growth fortress built to last for the long haul, or if it's just a financial trap waiting to spring on unsuspected investors. Okay, let's get right into it.
And right out of the gate, the market cast its vote. And believe me, it was not pretty. We're talking a 15% drop in pre-market trading. That isn't just a little wobble, that's a full-blown shockwave. Investors clearly saw something in that report that they did not like, and they ran for the exits. So my question is pretty simple. What did they see? Is this a sign of a genuine, deep-seated weakness in the company's structure, or is this a classic market overreaction that might actually be creating a buying opportunity? This headline right here really sets the stage for the entire battle we're about to unpack.
And here it is. This is the absolute core of that battle, laid bare. The bull case is built on a foundation of just pure, unadulterated power, a $6.9 billion revenue quarter. Look, they didn't just squeak by the expectations. They completely smashed them by almost $500 million. You just can't ignore a top-line performance like that. It speaks volumes about the sheer scale and the incredible momentum of their commercial engine. Okay, but that's precisely where the bear case comes roaring in. An engine that burns that much fuel, that hot, eventually just seizes up. They missed on earnings per share, and it wasn't by a little bit. Analysts were looking for 80 cents, the company delivered 63. Now that is the number that directly hits shareholder value. It tells us that despite all that massive revenue coming in the front door, the cost of generating it is eating away at the profits that actually belong to the owners of the business. So this isn't some small hairline crack. It's a fundamental question about the quality and, more importantly, the sustainability of all that growth.
Exactly, and that's exactly what we're here to do. We're not going to get swayed by one flashy headline number, either bull or bear. We are going to conduct a full structural analysis. So here's the game plan. We'll start by breaking down that headline shockwave. Then we'll build up the bull case and see how they're forging this massive growth engine. After that, we're going to flip the script, take the bear's perspective, and go hunting for the cracks in the foundation. But the real heart of our analysis today will be stress testing the three core pillars of their business. Only after all of that will we be ready to deliver the iron financial verdict.
All right, so let's build this bull case first. And let's do it with some intensity. Because before we can even begin to talk about cracks, you have to respect the sheer force of what this company has already built. We have to understand the scale of this operation. Because the numbers, well, they're frankly overwhelming. This is the foundation that the bulls are standing on. And from this angle, it looks like it's forged from solid steel.
Okay, let's zoom out from just the one quarter and look at the whole year. $22.9 billion in revenue. Let that number really sink in for a minute. This isn't some speculative startup with a good story and a flashy pitch deck. No, this is a global technology powerhouse that is operating at a truly massive scale. Revenue at this level, well, it builds empires. It creates deep, defensible moats around the business that are incredibly difficult for any competitor to even think about crossing. This is a business with its own financial gravity.
And here's the thing. That empire is still expanding at a breakneck pace. We are not talking about some mature, slow-growth utility company here. We're talking about a company that's pulling in nearly $23 billion a year and is still growing its top line by over 36% year over year. That right there is some serious heavy lifting. This tells you that the growth engine isn't just running, it's supercharged. The demand for their services across e-commerce, fintech, and gaming, it's not plateauing, it's accelerating.
And for anyone out there who thinks this is just empty, unprofitable growth, well, this slide is the rebuttal. A 260% increase in full-year net income. Let me say that again, 260%. They didn't just grow, they became vastly more profitable. They generated $1.6 billion in pure profit. This demonstrates incredibly powerful operational leverage. It shows that as their revenue scales up, their profits are scaling up even faster. So the crucial point is this is a company that has already proven it can translate its massive scale into massive profitability.
And there you have it, straight from the man in charge. The architect of this fortress, Forrest Lee, confirms that the strategy is working perfectly, exceeding our initial growth expectations. Think about that. This isn't a company that's struggling to hit its targets. This is a company that is outperforming its own ambitious plans. So from the bull's perspective, what you're looking at is a picture of flawless execution. You've got strong revenue, accelerating growth, and exploding profitability. This is the definition of a financial fortress.
Right, but even a fortress with a flawless exterior can still have termites chewing away at the foundation. The market sold off hard for a reason, and it wasn't because they were sitting around admiring the CEO's quotes. It's time to take out the magnifying glass and really examine these cracks. The bear case argues that this beautiful growth story is being propped up by something unsustainable. And the signs? Well, they're right there in the report, if you just know where to look.
So let's go right back to the scene of the crime, that Q4 earnings miss, an EPS of 63 cents when Wall Street was all geared up and ready for 80 cents. I mean, this is a significant miss. It sends a signal that in the most recent, most relevant period, their profitability just did not keep pace with what everyone was expecting. The bears see this and they say, see, the costs are getting out of control. The efficiency is slipping. This one number single-handedly challenges that entire narrative of smooth, profitable growth that the bulls are trying to sell you.
And just in case you think that Q4 was some kind of a fluke, a one-off mistake, well, look at this. This is not a one-time stumble. This is a pattern. Look at Q3. They missed estimates by a whopping 28 cents. Q2, they missed by 17 cents. And if you go all the way back to Q4 of 2024, there's another miss. The only beat they've had in the last year was a marginal one in Q1. The crucial point here is that this company has established a track record of over-promising and under-delivering on the bottom line. To me, that says their grip on profitability is not nearly as firm as they claim, and frankly, it calls management's forecasting ability into question. The foundation has been showing these stress fractures for a while now.
And this chart right here, this shows us exactly where that money is going. This is the price tag for that incredible 36% revenue growth we saw earlier. Just look at these expenses. Provision for credit losses, that's the money they have to set aside for loans they expect to go bad, is up almost 77%. 77. And sales and marketing is up nearly 30% to a massive $4.5 billion for the year. This isn't happening in a vacuum, you know? The e-commerce space is a brutal, cutthroat war for market share. They are literally pouring fuel on the fire to keep that growth engine roaring, but that fuel is becoming incredibly expensive. This doesn't look like disciplined growth to me. It looks like a spending spree.
So this brings us to the fundamental question the bears are asking. And really, it's the question every single investor needs to answer for themselves. Are we looking at a robust, self-sustaining ecosystem here, or are we looking at a structure that requires ever-increasing amounts of expensive capital just to keep from slowing down? Because if it's the latter, that's not a fortress at all. That's a house of cards, just waiting for a gust of wind.
All right, that is a fair challenge. You've pointed out the potential weaknesses. I've laid out the overwhelming strengths. So let's settle this. The only way to find out the truth is to go deeper. A company like C isn't a single monolithic structure. It's a compound built on 3 distinct pillars. So now we're going to move on to our stress test and see how these individual pillars really hold up under pressure.
Okay, here's the company's blueprint. Shopee, their e-commerce giant, is clearly the main pillar, the central load-bearing wall, accounting for 63% of Q4 revenue. But look closer at the diversification. Monee, their fintech arm, is already pulling in 16%, and Garena, their original gaming division, is at 10%. From a structural engineering perspective, this is a good design. They are not a one-trick pony.
I don't know, I see it a little differently. I see a company that is dangerously dependent on one single segment. If anything happens to Shopee, maybe increased competition, margin pressure, a sudden regulatory change, the entire structure is immediately at risk. That 63% tells me there is a massive concentration of risk in a single, highly competitive business line. The other pillars need to be incredibly strong to offset that. So, let's see if they are.
Let's stress test that main pillar Shopee first. These numbers look like they're made of solid steel. GMV, or gross merchandise volume, that's the total value of all the goods sold on the platform, is up almost 29%. Gross orders are up over 30%, and the revenue growth from that is even stronger at nearly 36%. And crucially, adjusted EBITDA, which is a key measure of operational profitability, is keeping pace perfectly, up 33%. This pillar is not just holding its own weight, it is clearly getting stronger. It's strong, sure, but at what cost? Remember that chart on expenses we just looked at? Sales and marketing for just the Shopee segment in Q4 jumped by 25% to over $1 billion. They spent an extra $250 million on marketing just to get this result. So yeah, while the EBITDA grew, they had to ramp up spending in a major way to make that happen. The question is, are we starting to see diminishing returns on that marketing dollar? Are they just having to run faster and faster on the treadmill just to stay in the same place?
Okay, now let's look at Pillar 2, money. And this is the real growth accelerant. A $9.2 billion loan book up over 80% in a single year. You heard me, 80%.
This fintech engine isn't just a pillar, it's a rocket. It's leveraging the massive Shopee ecosystem to build a huge, high-growth financial services business. This is how they diversify. This is how they build new, powerful revenue streams. This pillar is doing some incredibly heavy lifting for the whole company.
And it's also taking on an incredible amount of risk. Remember my point about the provisions for credit losses? They jumped 67% for the quarter. You can't just look at an 80% growth in loans in a vacuum without looking at the corresponding jump in expected defaults. They're growing the loan book aggressively, sure, but the quality of that book is a huge question mark. This pillar might look strong on the surface, but it could be hollow on the inside, filled with risky debt that could lead to massive write-downs down the road.
Okay, on to our third and final pillar, Garena, their gaming division. Here the story is all about monetization. Look at this. Total active users grew a pretty modest 2.5%, but the number of paying users jumped by 15%. This tells me they are getting much better at converting free players into paying customers. The paying user ratio improved by a full percentage point, from 8.2 to 9.2%. That is a sign of a mature, well-managed business that knows exactly how to extract value from its user base.
But the foundation of any gaming company, its lifeblood, is user growth. And a 2.5% increase in active users is, well, it's basically flat. It's approaching stagnation. So yes, they are squeezing more money out of their existing players, but that's a ticking clock. What happens when that user base starts to shrink? You can only increase the monetization rate so much before you hit a ceiling. This pillar, while it's profitable right now, has a potential long-term structural weakness if they can't figure out a way to restart that user growth.
All right, we've examined the headline shock, we've built the bull case, and we've explored the bear's cracks in the foundation. We have now stress-tested all three pillars, Shopee, Monee, and Garena. So now it's time to weigh all the evidence. It's time to put all the pieces together on the scales and forge the iron financial verdict. What does all of this actually mean for your portfolio?
So let's just summarize this one last time. The foundation, the bull case, is built on undeniable facts. Explosive, broad-based revenue growth across all of their major segments. They have a dominant, diversified, multi-pillar business model. And critically, they have a very strong full-year net income of $1.6 billion. They are a profitable, high-growth machine. But the cracks, the bear case, are just as real, and you ignore them at your own peril. There is a consistent pattern of missing earnings expectations that raises serious questions about management's guidance and their control over costs. And the costs to achieve that growth, particularly in marketing and credit provisions, are soaring. And you just can't ignore the market's reaction. The stock was punished because these cracks are visible and they represent a very real risk to the company's future profitability.
And this right here, this is management's plan to patch those cracks. The guidance they gave for 2026 is absolutely crucial. They're guiding for another 25% growth in Shopee's GMV. That's continued strong expansion. And they are committing that adjusted EBITDA will be no lower than 2025's level. This is meant to be a signal of confidence. They're telling the market they believe they can continue to grow rapidly while defending their profitability.
I'm not so sure. The language they chose is very specific. No lower than 2025's level is not the same thing as saying strong profitability growth. It suggests that profit growth in their biggest, most important segment could actually be flat for the entire year. To me, it sounds like they're bracing for a period of heavy investment to drive that 25% GMV growth. And for a market that's already worried about rising costs, that could easily be interpreted as a warning that margins are about to get squeezed even further.
So, we've laid out all the evidence from our stress test. On one side, you have a company with a powerful growth engine and a fortress-like revenue base. But on the other, you have visible cracks in its profitability and a strategy that requires immense, ongoing investment. This is not a stock for the faint of heart. It is a high-stakes, high-volatility name. And so, we're going to leave you with the final and most important question. Look at your own strategy. Look at your own risk tolerance. Now that you've seen the raw materials, the strengths and the weaknesses, is your portfolio forged to handle a company like this? That's the verdict you have to make.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.